it doesn't look like the market's priced in the idea of another hike later this year. I know a lot of people thought we were going to just see the end of the rate hiking cycle. Does this change your view of the markets from now until the year end?
It gets me a little more cautious, to be quite honest with you. Carefully was his word of the day yesterday, and he didn't say anything alarming. The alarming thing to me was the dot plot and the projections going forward. Right now the June projection is for rates to be over 5%, where last dot plot 6 months ago it was 4.6%. So we're talking higher for longer. And then the spikes in the twos and the tens, the fact that they're staying at these levels, that's troublesome. And then let's throw in headlines and your September headwinds, and it could be a rough few weeks here.
So, Janet, same question for you. A bit of a surprise to the markets, clearly a shock. I'm looking at the Dow right now, down almost 100 points in the pre-market, and the Nasdaq, the hardest hit, down more than 0.5%. Has this just thrown out what everybody thought the end of the year was going to look like, or do you still believe that this rally can continue?
So I agree with Jay. I think we have been cautious on our equity positioning because we are of the view that the Fed will keep interest rates higher for longer. So I think the dot plot definitely validates that. And in fact, I'm a bit surprised by the fact that they took 2 rate cuts out of next year and the next as well. So I think it is just a confirmation that we are going to see higher for longer interest rate, and as such, it will put more pressure on the economy eventually. I know that the economy is still resilient, but I think there are a number of macro risk factors that is materializing, and I think that higher for longer rates just put more pressure out there in 2024.
So, Jay, back over to you. One of the big takeaways from yesterday was the idea that the neutral rate, the so-called neutral rate, might change from basically 2.5% now to 3%. Does that really just change your longer-term view of the markets? I know both of you advise clients, and generally we have a lot of long-term investors in the markets. Does that change your long-term outlook?
No, it doesn't really change my long-term outlook. It just changes where you want to focus on, putting money to work right now. I think the consumer staples are probably a safer play right now. You look at the sectors that have started to rally, and if you're a little skittish, staples and utilities have finally lifted their head. They have a lot to reverse, and there are some stocks within those sectors that are, one, beaten down. So you can look at like a General Mills, which reported yesterday, a Hershey's, a Conagra, a Kellogg, that have something to reverse, are at nice little support areas and pay a dividend. Or you can go to the strength in that sector, like a Procter and Gamble, a Constellation, a Costco, which reports next week. So I don't think it's going to change my overall narrative on the market. I think tech has had a nice run, and it will be affected. It will pull back. I don't think it's going to be drastic, but I don't think we're going to see the rise that we've seen in the first half of 2023 continue into 2024.
So, Jay, I do want to ask you about this consumer staples play. You're saying it's about dividends, but when we see bond yields this elevated, doesn't that give a lot of competition to dividend-paying stocks? And then do you believe that staples will have more pricing power? Is that part of the thesis?
Well, it sure does. I mean, yes, you have options to put money away into safer plays, and my focus is always on equities. So when I'm talking about where you want to go, where you want to rotate into, right now at this time, I think that's where you want to be. Overall, no, I'm not worried that the market is going to be beaten down dramatically. I just think that the run that we had is on pause, and we always focus on the Magnificent Seven. We ask about it all the time, and that's all people want to talk about. I think that is going to be affected by this more than anything. I think some of those staples, those boring stocks, if you will, that'll be the safer play.
Yeah, I think the markets have had a lot of excitement just with the idea of higher for longer. So, Janet, I want to ask you, Jay's seeing a buying opportunity when it comes to staples. Are there certain sectors that you think now are more attractive now that we're in this higher for longer environment?
Yeah, I do think so. I think it's important to diversify your portfolio. And I think in this higher for longer interest rates, I think there is a case for bonds. And aside from that, because we saw that there's so much energy price volatility, and we think it is still going to be with us for a while because supply is still pretty tight and energy sector is still trading at a deep discount versus to the broader market. So in a higher for longer interest rate environment, you may want to own some low duration assets as a hedge. And I think the energy sector could be a good hedge for your portfolio when you have other areas in your portfolio that are exposed to high growth and high duration, for example.
All right, Jay, coming back to you. Jay Powell made it pretty clear. The outlook for cuts has changed dramatically. Do you still believe that we're going to see cuts next year?
Yeah, I think we're going to see cuts next year. The one thing I was actually concerned about was the need to cut so soon. That would kind of throw off his narrative that they've been getting this soft landing. All of a sudden, something changed and we have to cut rates quickly. I like the pause. I'd like to continue to see a pause. Him go carefully, as he said, digest the data, and then cut first quarter, end of first quarter next year. That would be kind of that nice soft landing ideal scenario. The higher for longer, it's going to really stunt a lot of these high growth names. And that's the concern, and that's why I think you have to rotate. And I believe energy is a great sector to be in. It's been the hottest sector the last 3 months, and I don't see anything slowing that down either.
Yeah, Jay, to your point, again, the NASDAQ, the hardest hit in the pre-market at least, down more than 0.5%. So, Janet, over to you. Do you still believe that we're going to see a cut next year? And just in general, just this whole thesis about what's going to happen, it's changed. Has it dramatically changed for you as well?
Well, I think that the thing is, when we see a cut, by the time we probably have seen a recession already, because I think the Fed will be reluctant to cut at the first sign of economic weakness. So I think, unfortunately, the risk of a recession is still pretty high, actually, in 2024.
Oh, really?
So I think that doesn't change our view of a cautious stance on our risk positioning and on the macroeconomy in general. So I think we just have to keep our cautious stance, and we currently have a preference over bonds, particularly UK bonds at the shorter end of the maturity side. We'll get the Bank of England decisions, and so we'll see how that play out.
So, Janet, just to be clear, you say you want to continue being cautious. So did you always believe there was a solid chance of a recession next year, or do you think the chance of recession has just increased dramatically because of this?
No, I don't think that at all. What I think is, we've had some great times, and we're just having a natural pullback. And as far as equities go, I don't think it's time to hit the panic button. I just think that rotational theme continues. If we break 4,200 in the S&P 500, I'll come back, and you're going to hear a different tune from me. Right now, we have digested a great run here in this market. We're seeing tech slow down. We're seeing other sectors lift that normally will lift. Financials are getting a bit of a lift as well. People don't talk about that. Stocks like Visa and MasterCard look tremendous to me. So I still think there are opportunities in equities. I just think there's a normal pullback. I think with one pause and maybe another quarter point hike, that could lead us a little higher at the end of the year. So I'm not too concerned.